Good morning, everybody. Welcome to Tao Economica, all about economics. Kalimera, Anthropoi. Welcome. Good morning, people. I'm very happy to be with you today. I've done a lot of work, and I couldn't sleep about that. So I worked until late night to understand some advanced concept of derivative pricing, like inflation swap curves, zero coupon inflation swap curve, zero coupon inflation rate swap curve, and why these derivative contracts are utilized by funds to hedge their liabilities and to hedge about inflation. And with this, with the work that I have, I'll be able to explain why in 2022 there was a crisis, the LDI crisis, funds, pension funds in the City of London, the UK, and why the swap market for inflation swaps, they are eventually a crucial component of the margin calls that these funds had to confront with. So yes, so let's start with some special data, which is the overnight index swap curve, which is derived from the normal yield curve, right? And from the overnight swap curve and the real yield curve, we can calculate what is the break-even inflation rate curve, which are these two charts. Okay, this is the overnight swap curve, the break-even inflation rate swap curve, and this is the normal BEIR, break-even inflation rate. So with these two charts, we see that they are downward sloping. So the near term, let's say the 5-year break-even inflation rate, they are higher, and they tend to diminish over time. But we see that in both charts, we don't have the break-even inflation rate converging to 2%. So these already are data for investment funds or bond funds, that they have to consider that inflation will be structurally higher, above 2%, at least according to what market are pricing, between what is the mark-to-market yield and the inflation-linked yield, and what is the real yield curve. Because we have, for example, these are the mark-to-market yields, and we see that, for example, the 10-year it's very close to 5%, as I was saying in the past video, that you can go and check it out about everything you need to know about the yield curve volatility. So, but I mean, what a bond fund is actually earning, it's the mark-to-market yield minus the average rate of inflation. Okay, so the real return of a bond fund has to be discounted by the prevalent rate of inflation. So financial markets, they utilize the swap curve and also the yield curve to basically build the break-even inflation rate, so that they can have an idea forward in time what will be the average rate of inflation, and so what will be the average rate of return that they can achieve. And this basically, it's useful for it's useful. I mean, it's a requirement for a fund if they want to basically have financial products and say, okay, I'm gonna give you a 2% return over 10 years with this bond portfolio. They have to be sure that they can provide 2% real return, and so they have to have the instruments at their disposal to do the calculation. So they can extract from the market, from the bond markets, and the inflation measure, what are the break-even inflation rates, and we can have the curves, the overnight inflation swap curve, not inflation index swap curve, and which is discounted as a break-even inflation rate, and the normal. So we see that the values here for the break-even inflation rate curve, we have a 4 4.4% here in the next 6 months, and then the break-even inflation rate in 1 year time, the market is pricing 4.25%. So these are quite a high level for interest rate. There will be a positive real return discounted by the rate of inflation, and we see that the curves slowly 2-year 4.14%, and the slope of the curve is downward sloping. And for example, in 5-year time we have a break-even inflation rate which is 3.8%. These are higher, definitely they are higher than the 2% price stability. This is the OIS curve. Okay, yes, it just gives us the data. They're pretty much, they're not so, they are different. So the OIS curve, it's less high. So in fact, the 5-year break-even inflation rate is 3.57%, while the nominal yield 5-year inflation rate, we saw just now, is 3.8%. So these are the basic tools to gauge what are the break-even inflation rate levels in 5, 10, 15, 20 years, 10 years time. So when investment funds, they have long-term liabilities, they need to know what are the level of inflation or the break-even rates level of inflation in order to achieve positive real return for their funds. So another element that investment funds, they tend to utilize to hedge against the risk of higher or lower inflation vis-a-vis their investment and their liabilities. So what is the payout that these funds they have towards their clients? So there is a whole market of swaps, which are the zero coupon inflation swaps, or the zero coupon inflation rate swaps. Sorry, and these are derived from the break-even inflation rate. But why funds do that? So funds, they can decide to enter in an inflation swap contract by, for example, being a buyer or a seller of inflation, right? So they can decide to pay what is the break-even inflation rate 5-year, which is 3.8%. Yeah, 3.8%, and then they want to receive what is the floating rate for a zero coupon inflation swap. Okay, so let's say if I find it, yeah. So the 5-year zero coupon inflation swap, it would be more like 4.5%. Okay, so the floating rate would be based on the zero coupon inflation swap curve. So if a fund wants to hedge its liabilities from inflation, they can pay the fixed leg, which is the 3.8%, okay, and then they can receive the floating leg, which is on a 5-year horizon, let's say 4.5%. So they are paying 3.8%, which is the overnight, for example, it could be the overnight break-even inflation rate, but they are receiving the floating leg, which is priced on the zero coupon inflation swap curve, which is 4.5%. So well, it's easy to understand. If I'm receiving 4.5 and minus 3.8, 4.5 minus 3.8, no, let's do 4.4 minus 3.8, so the fund will be hedged against its liabilities, and the swap will be profitable by 0.6% yield. Yeah, so return. So these are derivative contracts, which are very complicated, and yes, so funds, they utilize these derivative contracts to hedge the liabilities against what? The compounded rate of inflation, because again, the concept, the real inflation expectations, what consumers expect as the cost of buying goods and services, it's the latest data is 3.3%. Okay, but funds they cannot take the average rate of inflation. They need to discount the return of the bond compare vis-a-vis the compounded rate of inflation. So the compounded rate of inflation, for example, for CPI in the past 3 months, it's about, let me see the data that I have here. Yeah, it's about 6.8%, while the compounded rate for the retail price index for the past 3 months, it's 9.9%. That's why the zero coupon inflation swap curve gives me that the nearest term maturity it's 9.9%, and this zero coupon inflation swap curve is not calculated from the RPI. This has been calculated from the zero coupon, so the bootstrapping of the break-even inflation rate curve. And I had to ask the machine to do that. So let's see if I can do some simple algebra. Okay, so the UK inflation rate year on year was 2.6% in November, CPI 2.3 in October and 1.7 in September. Okay, while the RPI was 3.6 in November, 3.4 in October, 2.7 in September. Okay, so if we basically I'll try to see if I can do the thing here. If we want to calculate the compounded rate of inflation in the past 3 months for the RPI, then we will have 1 plus September, it's 0.027, okay, times 1 plus 0.034, okay, 1 plus 0.036, yeah, okay, yeah, so minus 1, okay, so this will be 9.7%, so 0.097, it's in percentages terms, it's 9.7%, so the cumulative rate of inflation according to RPI for the past 3 months, because we still don't have the December data, which will come out on the 15th of January, it's 9.7%. And we know very well that, for example, the inflation-linked gilts, so it has a lag indexation. It has a 3 month. It's calculated with a 3 months lag indexation. So they take the past 3 months and they see what is the cumulated rate of inflation, and then they calculate what is the coupon or the inflation uplift, basically. Okay, so the RPI gives you a cumulative rate of inflation of 9.7%, 9.9%. Okay, now if we do the same for inflation rate with CPI, okay, let's do the 9.7. okay, keep in mind this data, so 1 plus 0.017 times 1 plus 0.023 times 1 plus 0.026, and we have 6 minus 1, we have 6.6%. So the cumulative rate of inflation based on CPI, it's 6.6%. It's 3% less. Okay, and this is money that costs in public debt servicing, because if I do 6.6 times 1, 10 million, 100 million, so I have 6.6 million in inflation uplift cost. Okay, easy algebra. If I do 100 million times 0.097, the cost would be 9.7 million. Okay, if I do minus 6, shite, 6, I want 6.5 million, so there would be a saving of 3.1 million. Okay, on 100 million investment in an inflation-linked gilts. So I've already now I've showed you what is the money in hard money, hard money. What is the reason why it would be very useful to switch the inflation-linked gilts index method from RPI to CPI, because you have on 100 million, you have, for example, on the past 3 months, you have 9.7 million costs if it's indexed with a 3-month lag RPI, while instead you have a 6.5, let's say, million uplift cost for if it's indexed with a 3-month lag with CPI. Okay, so I don't say I want to help out, but this is easy algebra, and anybody can understand that it's 6.5 million on 100 million, then it's 65 million on a billion, and then it's 650 million on a 10 billion. So it's a lot of money that the government and the taxpayer, they can save, they can spare themselves to pay. So, but let's go back to the zero coupon inflation swap curve. So now we have realized that the inflation rate has a cumulative compounded curve which is upward sloping. Okay, and from the basically the break-even inflation rates, we are able also to strip out what is the compounded curve, and we see that the compounded rate of inflation is upward sloping. So in markets, they created these fancy exotic swap contracts, which are the zero coupon inflation swap rate, and they use, and as I said, they utilize these swap rate contracts to basically to hedge against the rate of inflation when they have long duration liabilities in their investment funds that they have to pay to their clients. Okay, so we start from the break-even inflation rate, and then we go fast forward, and we are able to calculate the zero coupon inflation curve, the zero coupon inflation swap curve, by applying some bootstrapping method, and yes, these are contracts that are basically utilized to hedge against the risk of inflation. So now, why in 2022 basically bond funds and liability driven investment funds, they had a huge margin call issue? Because in 2022 we know that there has been a problem with inflation, which has been created by geopolitics and also by supply chain, energy price shock. So inflation has gone up very much. It was 10%, 12%. It was very, very high. And so basically these funds, they I guess they were not buyer of inflation, so they hedged their exposure by entering in a swap contract. They were basically paying the fixed rate, which is based on the break-even inflation rate. Okay, and they were basically receiving the zero coupon inflation swap curve. They were receiving, so somebody would say, okay, if I'm paying 3.6% on a 10-year break-even inflation curve, and then inflation goes up to 10%, so the floating rate will pay me more. Yes, it's true, but because you are a seller of inflation, and the bond fund, they decided to pay a fixed rate, the value of the inflation swap contract on their side was losing money. So they were having a mark-to-market loss on their swap contract, and so this basically has put in motion the domino of margin calls, because these funds, they probably had a lot of playing around with the inflation swap market, and so when inflation went up, they were yes, probably receiving a higher floating rate based on the rate of inflation, but bear in mind that the compounded rate of inflation, it has a 3-month lag, so it doesn't work with the actual rate of inflation, but it has a lag of 3 months. But the value of the swap contract on their side, which was the fixed rate based on the break-even inflation rate curve, was losing value. Okay, it's the same as the yield curve goes high, the interest rate goes high, so the value of the bond goes down, the price of the bond decreases. It goes from £100 to £90 or to £85, so it goes below par, and then you have a mark-to-market loss or an unrealized loss on your bond portfolio. So when interest rates go up, the price of the bond goes down. Same concept is for the zero coupon inflation swap. So if I decide to enter into a swap agreement and I want to pay a fixed rate, then I'm exposed to I'm exposed to inflation volatility. And this is okay if inflation is stable, but if inflation goes up suddenly and I didn't see this stuff coming, then inflation goes up, the price of the swap goes down, and then I have a mark-to-market loss. So this is exactly what has happened in 2022 in the bond funds and the LDI funds in the city of London. They actually had, I believe, some large exposure in swap contracts, inflation swap contracts. Inflation went up a lot in 2022. The value of their swap contracts went down, so they received margin calls. So they have to add liquidity to cover their margin exposure, and to raise liquidity like cash or money, they had to provide collateral. So what is the most liquid form of money, or the most the nearest form of money to cash? So what is the corresponding debt instrument that is similar to cash? It's sovereign debt. Okay, so what is most similar to pounds? It's the sovereign debt. Okay, the gilts. Okay, the UK sovereign debt, or it can be US treasuries. Okay, US treasuries, they are the most liquid financial instrument. They are quasi, or they are the nearest form of money. They are, if I have a US treasury, I sell it into the market and immediately I have a price and I can cash the money. So the same concept, or the same, it's a level of liquidity is for UK bond market. Okay, so if I need money in a hurry, I just sell immediately bonds because I need cash. To do what? I need cash to cover the fact that inflation has gone up and my swap contract is giving me a mark-to-market loss, so I have a margin call. Where do I take the money? I sell bonds, because bonds are the most liquid form of financial asset, right? So by selling bonds, right, you have a lot of pressure on the mark-to-market yield curve. So that's why in 2022 and also now, yields are going up, because it's not the Bank of England that is doing quantitative tightening. Bank of England has reduced to the minimum level QT. They are doing, I think, maybe, I don't know the exact number. I heard from somebody who heard from somebody that the Bank of England is doing something 10 or 15 billion of QT. Yeah, so that's all the liquidity that they may be taking out from the system. But the selling of UK sovereign debt, it's all driven by funds, and I believe that funds, they are having still they have issues with their inflation swap contracts exposure, especially because inflation is going higher in the UK, and RPI was 3.4, 3.6. And we don't know, on the 15th of January we will have the data for December, and the consensus here is 3.8, so higher RPI, so inflation is going higher, and then they had to basically raise liquidity in the case that they are exposed with the inflation swap curve, right? So these are the dynamics that are at play in this environment. Okay, so you have a nominal yield curve, you have a real yield curve, what is the real rate of return of a bond. So if the yield is 5.4% on a 30-year gilt, but the real rate of return is a little bit more than 2%. Then funds, they want to know, they start to do all the calculus of the derivative contracts, and they want to know what is the break-even inflation rate going forward. So we see that this is upward sloping, this is downward sloping, because inflation in the long term, in 10, 20, 30, 40 years time, is supposed to be lower. And then from the break-even inflation rate, they are able to they utilize some not so complicated algebra of doing a zero coupon stripping, bootstrap, sorry, not stripping, the full Monty, zero coupon bootstrap method, and they are able to construct or to reconstruct the zero coupon inflation swap curve. So yeah, so basically, not basically, this is the work of derivative desk. So people who work for funds, and they work on the derivative desk, and they have to price interest rate derivatives or inflation swap derivatives or credit derivatives. They must have all this data, because this data is not available in the market. The funds, they have to work it out by themselves, or probably they are available in like on a Bloomberg terminal or a Refinitiv, like Reuters, like, I mean, in professional settings. So these are data that is not available to the public. The swap market or the derivatives market, there are very little data that is available on the internet. So funds, they have to day to day or week to week, they have to update what is the zero coupon inflation swap curve. They need to know what are the break-even inflation rate in order to hedge against the risk of inflation. Also, because we see that the real return of bonds, it's very little. Like in 5 years, you would be earning between 0.5 and 0.75% on a bond portfolio, on a 5-year bond portfolio, base discounted for the rate of inflation, if you are investing in UK sovereign debt. So, as I said in the other episode about what all you need to know about the yield curve, the yield curve volatility for the gilt market, is that the UK market are discounting structurally higher inflation going forward, very long in the future, for the whole curve, 5-year, 10-year, 30-year, 40-year. Yeah, we can see it again, that the break-even inflation rate, they are 4.4 in the next 6 months, next year, and they will be in 40 years time 3.2%. So we are well above 2%, because of course these are the break-even inflation rate, but so this means that the nominal yield has to be higher and higher and higher in order to discount a structurally higher rate of inflation. So inflation, again, it's I want to re-emphasize this concept, which is a structural problem for the UK economic engine. And yes, we saw that yeah, inflation expectation, they are 3.3%, and yeah, food inflation 2%, RPI 3.6%, core inflation 3.5%, services inflation it's 5%, and rent inflation, rents are 7.6% on average on an aggregate scale. But for example, in London, rents have been growing in the past months by 12%. So the housing component of the inflation aggregate, it's very heavy on the upside. So rents are growing in Greater London by 12% and 7.6% month on month on a now if we want to calculate the compounded rate of inflation for rents, yeah, renting a flat, like the average rent in London is two grand a month, more than £2,000. So we can calculate, okay, so January 2024 rent was 0.8 it was 6.5%. Okay, let's do it quickly. 1 plus 0.065 times 1 plus February was 0.069 times 1 plus 0.072 times 1 plus 0.069 times 0.0 times 1 plus 0.072 times 1 plus 0.071 1 plus 0.072 August time 1 plus, I have to say it's very cold, I'm really chilling. 0.072. I hope it won't come out as a big mistake. So we have 1, 2, January, February, March, April. Oops, I think, okay, so some 1, this is July, August, September, right? Yeah, so it's 1 plus July, August, September times, yeah, 1 plus 0.0, I think I'm, no, September, October, times 1 plus 0.076 equal 1.64 minus 1. Hey, here we go. So I showed you now that from January, this should, I think it's more or less, it's precise. The compounded rate of inflation for rent inflation in the UK from January to November 2024, it was 65%. Okay, because month on month rents have been growing or increasing. January there was an increase on average of 6.5%, February 6.9, 7.2. Now if you basically take the month percentages and you calculate the compounded rate of inflation, you come up with a very large number, because it's the power of compounding. So of course on the telly they like to tell you, okay, the average rent inflation was 7.6 in November. Okay, but ordinary people, they pay rent every month, so the cost of inflation, it's every month, or the cost of inflation, it's every time you go into the shop and you buy chocolate or bread, milk, butter. Okay, you pay VAT and you pay the cost of inflation. That's why inflation is not an average number month on month, but it's a compounded cost on consumers, and it's a really, really unfair tax. And it's even more unfair because wealthy people that speculate on Wall Street and buy and sell shares, they don't pay VAT when they buy and sell stocks, right? And they even manage not to pay capital gain tax, so they don't pay VAT, they don't pay the cost of inflation, they take their profits and they don't pay anything at all. So I'm a strong advocate for a VAT sales tax on stocks trading, okay? Because this is really, really unfair, and I'm basically I'm challenging you on how the system is rotten, yeah? Because ordinary people, they go for their basic stuff like toilet rolls and water, bread, milk, and shampoo or toothpaste, or if they go to the doctor because they don't want to go to NHS and whatever it is, they pay VAT and they pay inflation, which are the profits of corporate. And then wealthy people, they have their stock portfolio, their bond portfolio, and they don't pay sales tax. Yeah? There is not a tax on stocks trading. And why this happens? Yeah? Why this happens? So a fairer economy, yeah, would include a transaction tax, yeah, or a sales tax on stocks, on trading stocks and shares. And then I think that everybody around the world even the US Treasury or the Euro area finance ministers or the Exchequer or the Japanese or wherever, they would raise enough money to pay for public services if we impose rightfully a transaction tax on stocks, shares trading, ETFs and stuff like that, because it's unfair, it's totally unfair that people, ordinary families, they pay inflation, they pay VAT, they pay tax on the ordinary goods that they need to live or to feed their children, and people with millions and billions, they don't pay a penny in a transaction tax or a sales tax. They don't pay VAT, they don't pay even capital gains tax. If they are not realized, the capital gains, then they have all sorts of manners how to avoid tax. Okay, so if you listen to me, I would love you to be promoters of a global transaction tax, okay? On top of global corporate tax for the internet giants that basically sell everywhere and then don't pay tax in the country where they sell goods and services and they extract profits, okay? Amazon delivers parcels all around the UK, Ireland, and France, and Germany, and then they pay tax in Luxembourg, right? This is not right. This is totally not right. Okay, so there are places where to raise money, transaction tax. Corporates, they have to pay tax in the country where they extract profits, and then we see if public finances can be balanced or not. So let's move on from this, and I showed you my overnight work on the zero coupon inflation swap curve, and yes, I happily tried to explain what happened back in 2022, so that pension funds still are exposed probably to inflation swap contracts. So it's of a paramount importance that inflation basically goes to 2% for the UK economy, and I think this would be also a problem for the United States economy, because oil prices are back up again, gas prices are back up again, and today we have our market calendar. We will have PPI, producer price index, and core producer price index data, and these are producer price index, trade services, final consumption. And yes, I went through the time series, and I have my forecast for today, which I can show you now on the Jupyter environment. Okay, very, very, very nice. So this chart is the month-on-month producer price index for ACO all commodities, and I have an ARIMA forecast and a rolling mean forecast, which is less precise. And the ARIMA forecast, it's more or less, I believe, we have here the column which is consensus with this value. But this PPI is not, it doesn't correspond exactly to this one, but it corresponds to, let me have here the Fed. Yeah, it corresponds to final demand for goods and services, which is the third graph. So, so producer price index, final demand for goods and services, this one is the forecast, ARIMA forecast and the rolling mean forecast for the month-on-month data that will come out later today, and this is the forecast for the year-on-year. So the ARIMA forecast basically comes up with a rising producer price index and more or less stable month-on-month change, but still positive. So the compounded rate of change of producer price index on a year-on-year basis, month-on-month basis, that will build up in the year-on-year basis, and we will have rising producer price index. So this means that will bring higher inflation. And then here we have another ARIMA forecast that is, I will tell you now exactly what, I think this is core core producer price index. Bear with me. So this one is 1, 2, 3, the fourth chart. So yeah, so this is producer price index, final demand, so total demand, excluding food and energy. So this is core PPI. Okay, so core PPI year on year was 3.4% in the month of November. So this in morning in the United States and the afternoon in Europe, we will have the December data, and the consensus is 3.8 core PPI, and my forecast, yes, the ARIMA forecast also shows that core PPI will go to 4% in 2025, in next month. So this fifth chart is, bear with, producer price index, final demand less goods and services, and for trade services. So it's this one, PPI ex food and energy, trade services month on month, and then year on year. So the month on month past data was 0.1%, the year on year data was 3.5%. So we don't have a consensus, so I can do some work here and see that the month on month, no, this is the year on year data, still will be stable around 3.5, 3.6%, and the month on month will be 0.2, 0.25. And yeah, here we have the oncoming forecast. So the producer price index or commodities will be 0.14%, and while the rolling mean for no, I apologize, bear with. Okay, so producer price index year on year, the ARIMA forecast is 2.5%, 2.5%. Let's confront with here is 3%. No, I don't think it's that the correct WPS FD. Okay, so okay, this one, bear with, I will tell you. So this is the forecast for December of the PPI year on year, core PPI. Core PPI, yes, less food and energy, so it's 2.5%. Core PPI 3.4%. It's lower, but I think I'm messing around with this stuff. Okay, core PPI forecast 3.5% in December and 3.6% in January. So this will be a growing core PPI, which is I didn't take the data from this website, so I'm not just a bit struggling to match up the send use Fred data with the economic calendar, but I think I got even more than what is on the forecast, and I just need to make sure I'm not messing around with these things. Okay, so let's go back to this. I want to see what was the previous data so that I'm able to match up the time series, and so it's the fourth and fifth chart for the year-on-year figure, for the year-on-year data, and core PPI is the third chart. Okay, so I can ignore the first two data, sort of, and then from the third chart. Okay, so let's go back to the chart, let's do it together. Right, so this is the core, this is the chart for the core PPI month on month. Okay, and the ARIMA forecast, it's this one, 0.28% month on month in December and 0.27 month on month in January. So, and then basically the machine comes up with the same data for the following months. So the rolling average is 0.24%. So we are talking about 0.25 or between 0.2 and 0.3 month on month. yeah, core PPI. And the past data was 0.2, the consensus is 0.3, the ARIMA forecast is in line with consensus that I have on my data, on the market data. Then, the year-on-year core PPI, the ARIMA forecast is 3.5 for December, 3.6% for January, and 3.7% for February, and the ARIMA forecast for core PPI is 4%, going up to 4% for all 2025. Yeah, so we will have rising core PPI for all year, and yeah, core PPI November was 3.4, the consensus for December is 3.8, so the ARIMA forecast is more or less in line, it's a bit lower, it's 3.5, alright? And yeah, so if market consensus, I think it's wrong, this data is wrong. Yeah, market consensus, it's 3.8. We see here forecast 3.5, so the market consensus is wrong. So this data, it's made up to basically, I think, sort of manipulate algorithm trading. Okay, so if in an algorithm I put that the market consensus for core PPI is 3.8%, very high. Okay, the forecast, which is the most accurate data, is 3.5%. So basically, the data that will come up today will be 3.5% or 3.5 or 3.6%, will be less than market consensus. So all the talking heads on the telly will tell you, oh, it's less than the market consensus, the inflation, the Fed is down, blah, 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 let's buy stock, let's buy stocks, okay? So this is all just going around and creating a reason to speculate. But core PPI was 3.4, the forecast is 3.5, the consensus is 3.8, and the ARIMA forecast is 3.55 for December and 3.6 for January. But crucially, the ARIMA forecast tells me that core PPI will be rising for the whole year, okay? And this is just only the PPI time series. There are no exogenous variables, which can be oil prices or gas prices or any other variable that can be worked with the producer price index, okay, like import, export, or whatever. So if energy prices are likely to bid up again in 2025 and gasoline is going to be a lot expensive, then core PPI is going to be 4% and maybe more. We will have another inflation problem again. And yes, the UK has been in stagflation. This is another thing that they won't tell you, but everybody sees that the UK has been in stagflation for the past 3 years. It's an economy that is in stagflation, and they are not doing anything concrete and reasonable to pull the country out of stagflation. The Bank of England is in a difficult position, also I think because they have this bond funds problem with the inflation swap market and stuff like that. And yeah, okay, so we have the forecast here, 3.5, it's exactly in line with what is the forecast on the calendar. And let's see trade services, which are these data. Okay, definitely sure that bear with, yeah, okay, so this one, this is producer price index, final demand, less food, energy, and trade services. And the ARIMA forecast is 3.5 for December, yeah, 3.5% for all Q1, and basically 3.5% for the whole year. And the month one, instead, if we take a look at the rolling average, for the core PPI less food, energy, and trade services, the forecast is 3.75%. Yeah, but the rolling mean, it's not very reliable in this case. The ARIMA is perfect to do that. And this measure is the month-on-month percentage change, and we have a forecast of 0.21. So let's go back on the calendar and we'll see, yeah, that core PPI excluding food, energy, and trade services year-on-year is 3.5 was the previous data in November. The forecast is 3.6%. There is no market consensus about this stuff. So you see, they don't have a consensus on this measure, but I have a forecast which is in line with the forecast that is on the economic calendar, and we are talking about 3.6% for this statistical measure, core PPI, excluding food, energy, and trade services, but 3.6% it's higher than the theoretical 2% or 2.5% inflation aim of the Federal Reserve. So central banks still, they don't achieve their inflation target, but we saw that the cumulative rate of inflation is much higher, so it's all bullshit. And yeah, the month-on-month its forecast is 0.2%, and the ARIMA forecast it's very bang on in line, 0.20 or 21. So but cumulatively month-on-month it will be a higher cost. So what we got here, yeah, core PPI, these are core PPI excluding food and services, and here we have these very nice charts. Yeah, we can see that this is the forecast for core PPI excluding food, energy, and trade services. That will be around 3.6% for all 2025. But crucially, core PPI, it could go up very much to 4%, and this will fit through also into the CPI and the core CPI inflation, especially in core CPI. Core PPI goes to 4%, let's say, and let's have the United States core CPI user. If you don't use it, you lose it. Right. The core inflation was United States core CPI was 2.4. No, let's use this one, which is more reasonable, 3.3% core inflation rate. So if, I mean, core PPI was 3.5%. So, and it will grow to 4%. This will put pressure. Core PPI will put pressure on core inflation from 3.3 to 3.5, and eventually maybe higher, and this will diverge from the inflation aim of the Federal Reserve. So this will be an headache for monetary policy, I'm pretty sure. And I don't know how the Federal Reserve will be able to do so many interest rate cuts in 2025, and I think the ECB is well offside probably. We all like lower interest rates, but inflation is going up again, and we don't know how or what's going to happen in 2025. We hope that will be a peaceful year. So these are the forecasts. Be merry, be happy, don't worry, everything is fine. And let's go back to today's economic calendar. And more or less the takeaway from the PPI and core PPI data that it's coming up later in the day or early in the morning for the East Coast of the United States, it's that core PPI, the forecast is 3.5, but I have a nice forecast that brings core PPI to 4% in 2025. So we will have a rising cost of producer price index that can put pressure on core inflation, and this will be a data point that the Federal Reserve will have to consider in monetary policy. And yes, we have seen finally this derivatives market dynamic of the zero coupon inflation swap curve, and why basically funds in the city of London, they had this huge problem with their exposure on zero coupon inflation swap curve contracts. And yes, let's see how market yields are performing today. If I can see the page, let's oh, it's gone. Actually, we can go through again. Yeah, I had some. You can go and watch my video about treasury, the treasury yield curve volatility, and my basic treasury forecast with the CIR model and the Vazquez model. They are bang in line with the market. Actually, we will see it now. So let's have a look what the bond market is doing this morning. and we see that France, it's more or less it's stable, but we have, well, this is not much movement at all, but still the 10-year OAT, it's 3.46%, and the spread on the Bund it's widening, although the Bund is moving a little bit more. We are here at 86 basis point spread for the OAT on the Bund, and Greece it's performing very well. Why? Because Greece it's always working with the primary account surplus, so they don't have fiscal deficit, but they have this self-imposed rule of cyclically adjusted primary account surplus, and the market it's awarding them with the lower interest rate premium. Also because the Greek economy is not an inflated economy. Greek assets are cheap and are reasonably priced. I mean, if you want to have a business in Greece, you won't be taxed to the L, or I mean, the cost of running a business it's reasonable. So it's an overall economic environment that can be profitable, and so this is reflected in cost of borrowing. And yes, in the fiscal policy discipline. Okay, so we have the 3.46, and yeah, the 10-year Greek bonds, it's a little bit in line with France. And we see that France, all the countries that go through the boundary of the 100% debt to GDP ratio, they have a physiological fiscal policy crisis. This is inevitable. Italy, it's a little bit contained, but we see the 10-year BTP is 3.8%, and with the 1 year with the 1% GDP or less, so even the 1 year it's 2.5%, so the debt will be growing by 1.5%. If GDP is 1% and the 1 year BTP it's 2.5%, so debt to GDP ratio will be increasing by 1.5%, so debt will be growing faster than GDP. And Italy, I think we are at the end of a large meal, which is at the fruit salad. We are, yeah. But I will be working on Italy data, and we will see how things are panning out. And yeah, Spain, the 10-year bonus 3.3%, so more or less behaved, but still it's less than France. So there is a rising wave of yield curve across the chopper block, and UK is the most volatile. And I repeat again, volatility it's driven also by the inflation swap market and the break-even inflation rates. And yeah, because there are derivative contracts and funds that are playing around with these things, and they have exposure to this stuff. And I think that there is a problem also with fiscal policy, which I'm not gonna go through now. And the treasury market still it's not fully open, but we see that the 20-year and the 30-year they are back at 5%. And bear with. I'll pull up my CRR and Vlasic forecast. Pull up. Bear with. Yeah, okay. Let's see. Just. Alright. Yeah, I have more than. I performed for the treasury market. I performed more than one CRR forecast. So we will go back up again with yields also in treasuries. There is no way that this ain't gonna be the case, I'm pretty sure, because I got the blues, brother. I got the blues, I got the jazz, I got everything I need to know what the market is doing. Right. So yeah, our Vaschek model tells me that the 1 year treasury will go up, also the 3 months. So if the short-term T-bills, they are T-notes, they are going to increase. Those are reflective of the Fed, and I don't think that would be the case unless the Fed is hiking. So the CIR, I think it's more plausible, but maybe it will be at 4%, but it's uncertain. You see, the 3 months, 4%. Let's see what are the market yields now. We are 4.3. So the yield curve, it's basically, the treasury yield curve is basically flat at 4.3% from the 30 days to the 180 days, right? And the 1-year treasury is the most reliable yield that it's approximated to what is the monetary policy transmission in 1 year time, so 4.2%, where the market is now. Yeah. So 6 months, yeah, we have a diverging, but both the Vasicek and the CIR, the Cox-Ingerson-Ross model, they give me a rising 1-year treasury. So the forecast for the machine, it's a rising 2-year, going to 4.5%. Let's see what are the rates now. 4.39, 4.4. The 3-year could go up to 4.5, 4.53, and we are almost there. The market yield is 4.48. So the machine, yeah, this is the first 2 months, yeah. Let's see, January 4.48. This is bang in line. This is exactly the 3-year where it is now, yeah. And the high of the day of yesterday, all my troubles seemed so far away, was 4.49. Alright, and we are bang in line with the forecast, guys. And yeah, this is very, very reliable, and I believe that the 3-year yield will be here or will go to 4.53%, but maybe it will be faster than a 12-month steps forward. Let's see, the 5-year, yes, 4.5%. So both the interest rate models forecast the forecast rising 5-year yield 4.6. I think this is higher than the forecast, yeah, because the market yield is 4.6%. So this is well exceeding the forecast. The 7-year, we have a divergence 4.7. Let's see where the market is. 4.7, yeah. This depends also from the supply of treasury and the demand of treasury. So the Vasicek model tells me that the 7-year treasury will be around 4.7, 4.75%. The 10-year 4.65. The CIR model gives me a decline 10-year. I don't believe the CIR, and we are at 4.8 for the 10-year, and yeah, this is not captured in the declining 30-year, but we see that the long duration it's rising in treasury yield curve. So we are having, I think market should be prepared to have also volatility in the treasury market. Funds should be prepared for volatility in the treasury market, and yes, especially if PPI, producer price index, core producer price index, and core inflation will be rising again, then this can be a spooking factor, a volatility factor for yields, for the yield curve, and there will be a lot to play. And I think I want to see what will be the reaction of central banks. So with this, I have to love you and leave you. And yeah, the 10-year yields, it's going to 5%, I told you, and the 30-year yield will go to 6%. So be prepared, and I told you. All right. So have a good day. Have a productive day. All the best. And yes, I'll be back up with some other updates and some other cool material as inflation swap curves. All right. Take care, buddies.